In this week's video, we'll review the charts, including numerous risk-on, risk-off ratios, to help us better understand the long-term outlook for stocks. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a weekly chart of the S&P 500 index that shows the peaking process before the financial crisis. This week we'll be looking at the generic, and for illustrative purposes only, a little bit faster moving averages this week. We'll be using the 15-week exponential moving average in blue and the 20-week exponential moving average in red. Clients and regular viewers know that a full-bore bullish look when the odds are in our favor is when price is above both moving averages, blue is above red, and the slopes of both moving averages are up. You can see here late in 2007, early in 2008, we get a full-bore bearish look with price below both moving averages. Blue is below red, and the slopes of both moving averages are now down. After we can see this and measure it, really bad things happen. And when a bear market ends, eventually the long-term trends flip back to a bullish stance, and we did move to a full-bore bullish look using the same generic weekly moving averages. Here we have price above both moving averages, blue is above red, and the slopes of both of them are up in calendar year 2009. Therefore, we can gain a better understanding of the present-day risk-reward profile by comparing it to these extreme periods. If we look at the exact same moving averages on April 20th, 2017, we can see for the most part that the present-day chart looks a lot more like this bullish turn from the 2009 bottom and really doesn't look anything like this bearish turn here. And notice before the bearish turn, the moving averages get very, very tight, telling us that we may be in for a big move. We just don't know which way it's going to go. In this case, it was a bearish move. We really don't have a tight look with the moving averages here telling us even if we were going to roll over, the topping process would probably take some time, and these moving averages would most likely start to move closer together. Right now, this still looks like a relatively strong and bullish trend on April 20th, 2017. Common economic sense tells us that as the market starts to roll over here before the financial crisis, the conviction to own growth-oriented stocks starts to wane relative to the conviction to own defensive-oriented bonds. We can see the trend change here, and after that, really bad things happened in the stock market. Conversely, economic common sense tells us that the conviction to own growth-oriented SPY or stocks started to pick up relative to the conviction to own defensive-oriented treasuries as the stock market bottomed in 2009. How does the exact same ratio, using the exact same, for illustrative purposes only, moving averages look today? April 2017, we still have a full-bore bullish look with our moving averages. We don't have price above the moving averages, but you'll notice here during a trend, we get counter-trend moves, counter-trend moves, counter-trend moves, counter-trend moves, counter-trend moves that don't necessarily tell us that the trend is about to end. Right now, this looks like a normal counter-trend move within the context of an ongoing uptrend. Obviously, that's subject to change, and this chart could morph into something like this, but it hasn't yet. This gives us a little bit better idea of somewhat of a normal retracement. Here's the big pop here near the U.S. election. We really haven't retraced a significant amount of this A to B move here, and right now in this ratio, this looks like a normal retracement within the context of an ongoing uptrend. Owning financial stocks and or banks, XLF, in the ETF world was really not a good place to be during the financial crisis, and the ratio of XLF to intermediate term treasuries, IEF, in the ETF world, rolled over in calendar year 2007, and it rolled over well before the stock market peaked in October of 2007. And for the most part, we maintained a full-bore bearish look during the entire bear market with normal and to be expected counter trend rallies within the context of an ongoing downtrend. Similar situation here. The conviction to own banks started to pick up relative to the conviction to own defensive-oriented bonds in 2009. We have an established bullish trend and 100% normal and to be expected counter trend rallies within the context of the ongoing bullish trend. How does the same ratio look on April 20th, 2017? Does it look more like this constructive period or this concerning turn that foreshadowed bad things in the S&P 500? We still have a lot of white space between the moving averages. They don't have that tight, we're about to roll over into a bearish trend look, at least yet. If we look at the move in this ratio, this is November, this is the U.S. election here. Here's the A to B move. So far, and this is subject to change, this looks like a normal retracement, a normal retracement, a normal retracement within the context of an ongoing uptrend. We're not using this chart to forecast. We're open to all outcomes, including seeing this ratio morph into something like this, but we don't forecast that either. We allocate based on the facts in hand, and the facts in hand unequivocally look a lot more like the right side of the screen than the left side of the screen. We can use the same concepts to monitor the long-term trend in small caps. We get the bearish moving average crossover here in calendar year 2007 as the S&P 500 is peaking here. After that, after we could see it and measure it and capture it in a model, really bad things happen. Conversely, as the market started to right itself, we'll get the bullish moving average crossover, and then we maintain blue above red as the market turns in 2009. The exact same chart using the exact same, for illustrative purposes only, moving averages as of April 20th looks a lot more like the right side of our screen and really doesn't look anything like this period here, this low probability look that would concern us. Right now, this looks like a bullish move, a bullish trend, and this looks like consolidation within the context of a bullish trend. Like all the charts, it's subject to change, but it hasn't changed yet. And small caps also remain well above the breakout level from their consolidation box from 2015 and 2016. The basic premise of the CCM market model is to monitor and adjust if needed, and for the most part, to have our capital in harm's way when the odds are in our favor, and to move our capital out of harm's way and to migrate toward defensive assets when the odds start to shift, and then to stay in a defensive posture when the odds are clearly not in our favor. How important or how helpful can it be to avoid or mitigate these gigantic drawdowns that inevitably occur in a bear market? And it's not a question of if another bear market is coming, it's simply a question of when. Let's assume that we invested $1 million in SPY, or the S&P 500 ETF, on March 24th, 2000, or better yet, let's assume we invested 10 years ago, and we held in our account on March 24th, 2000 was worth $1 million. The blue line shows our portfolio value owning, buy and hold SPY and reinvesting the dividends. You can see we had some volatility here and a drawdown in October of 2000. We could see, measure, and record that full-bore bearish look that we just covered in October of 2000. Our drawdown isn't all that bad here. We're sitting somewhere in the neighborhood of 930,000, but the odds are starting to shift from a longer-term trend perspective. Let's assume that in October of 2000, we just decided that we were going to be a buy and hold investor. How long did it take an SPY buy and hold investor to get back to break even, or more importantly, sustained new highs, where we moved back to $1 million and then moved away from $1 million and never dropped below $1 million? So in this case, we're assuming that we ignored this signal here and held. This is our portfolio value here. We have the two devastating bear markets, and if we take the buy and hold portfolio forward from March 24th, 2000, if we fast forward 4,288 days, our portfolio once again is worth $1 million on December 20th, 2011. The answer to the question, how long to get back to break even or sustained new highs? We made a new high here, but it was not sustained. The answer is 11.75 years. The miracle of compounding can work for us, and it can also work against us. Therefore, under our approach, we prefer to maintain and migrate toward a defensive posture when the evidence, the weight of the evidence, starts to change. Looking at the same moving averages on April 20th, the weight of the evidence has not changed in a meaningful way, and therefore we have made very few adjustments. We have made no adjustments to our SPY holdings. And like everything else, we'll take it day by day. Given this 11.75 years represents an incredible opportunity cost relative to our investment capital, and given the model would take defensive action when the weight of the evidence, and we're using these for illustrative purposes only, when the weight of the evidence shifted. How does this quote fit in to our game plan? When we have established and bullish trends, for the most part, we would prefer to sit tight, invested in growth-oriented assets. We migrate here. Once you're in an established downtrend, instead of giving the bullish trend the benefit of the doubt, you are skeptical of any counter trend rally. You are skeptical. The evidence hasn't changed. The evidence has not changed. No change in the evidence. No change in the evidence. Blue is still below red, and the slopes of both are down. We're still trying to sit tight here and stay invested with the long-term and primary trend. The only difference is what we're invested in. On the left side of this chart, it's growth-oriented assets. We try, for the most part, as long as the math allows, to act like buy and hold investors, understanding that the market will always have counter-trend moves. Same situation on the right. We try to stay invested in defensive-oriented assets such as bonds, understanding that counter-trend moves are inevitable within the context of even a primary downtrend. We're going to shift gears here and take a moment to review some basic concepts. If I showed you this chart as of April 20th, 2017, and I told you that this was the 200-day moving average, and I owned this position, and I was a longer-term investor trying to stay invested with the primary trend, and I asked, should I be in any big hurry to get out of this investment? My answer would be no. The long-term trend appears to be intact. If anything, it looks like we're at the early stages of a new trend. The chart that we've been looking at is SP high beta, SPHB, relative to SP low volatility, or SPLV. This is our economically sensitive sectors relative to an overweight in defensive sectors. Defensive sectors have been outperforming in the short run. However, you can see the underperformance of SP high beta in recent weeks and even months has not altered the long-term trend as of April 20th, 2017, telling us that the current move still appears to be a normal and 100% to be expected counter-trend move within the context of an ongoing and already established uptrend. This, like all of the charts, is subject to change, but it hasn't changed yet. Let's flip to another example. Once again, we're looking at a daily chart with the symbol removed to remove our personal biases. If I told you that this ETF moved from point A to point B and had a retracement that came back above the 38.2% retracement level and well above the 50% retracement level and well above the 61.8% retracement level, would you tell me that the probabilities favor a higher high or a lower low? At this stage, my vote would be a higher high. This looks like a normal pullback within the context of an ongoing and established bullish trend. If we review the facts on this chart as they stand today, and of course they're subject to change, there's nothing on this chart jumping up and down telling us that this bullish trend is about to end. The further and deeper we go here, the higher the probability that we get a trend reversal. If we put the symbols back on the chart, we're looking at the exact same ratio. We're looking at economically sensitive SP high beta relative to SP low volatility that overweights defensive sectors. Given the facts that we have in hand as of April 20th, 2017, from this A to B move, this looks like a normal retracement or counter trend move within the context of an ongoing and established bullish trend. And if we add in the 200-day moving average, you can see we're relatively early in this new uptrend here. And we also have a pullback that appears to be coming back and testing basically the 200-day moving average. So far, price is held above the 200-day moving average. If price drops below the 200-day moving average, does that mean all bets are off? Absolutely, positively, no. It is not uncommon for price to drop below an upward sloping 200-day moving average within the context of an ongoing uptrend. Like the other charts that we've reviewed in this week's video, there are no major red flags here. Maybe some yellow flags telling us to pay closer attention and to keep an open mind, but there's no red flags on this chart looking at the fibs, the retracement, or the 200-day moving average. All of that is subject to change, but it hasn't changed yet. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.